look at the some of the option strategies, and also so definitions of two types of strategies. One is a butterfly, and other is a three-legged structure. So yesterday night the Fed announced the decision, which is today's morning time, Indian time, and it was a very hawkish communication. Fed increased rates by 75 basis points, so that was at least expected. 75 basis point was expected, but what was expected is that there will be at least there will be some toning down of the hawkishness. That is, you may say that probably we are coming to some sort of a pause in interest rate after one or two hikes, but that didn't happen. They increased it by 75 basis points, and then the communication that Fed gave is that this may again be increased by another 75 basis points in next meeting, and probably by another 50 basis point before December ends. So we are looking at another 1.25% up in the next. Now it's September, October, November, December. So in these 3 months, another 2 meetings possible, and now the Fed rate has already come closer to the 3.25 to 3.5 range. Okay, now this is going to cross 4% by December end. So that is for sure. We may see 4.25 by December end. So this is the decision which has hurt the market sentiment, particularly the global markets. As we have been saying, that Indian markets is not going in tandem with the US market or global markets. We are behaving very differently. We are almost decoupled from the global markets, particularly with the US market. But nevertheless, there is a gap up, gap down trades which keep taking place, which is really hurting the overnight positions, because till yesterday if you are long, or day before yesterday you are long, suddenly it opens down by 150 points and then triggers certain stop losses, then it again revives to some extent, then again it has a fall. So there is some sort of an intraday volatility with a gap up or gap down. So it is really causing a lot of problems for those who are trading trend manner following the trend, particularly in a shorter time frame, which could be 1 hour or so, 1 hour time frame. So if you do that, in that case yesterday you might have had an open position, only to see that being robbed off today by stop losses at the open, and the moment it opens at some lower level, it starts to pick up some momentum again on the upside. So this is creating a lot of issues as far as the trading positions are concerned. So we need to be very careful about trading, because to a very large extent we may suffer many number of losses and big defeats and big drawdowns. So to avoid that, we need to look at some other type of strategies which could probably help us to keep calm and look towards making some money over a particular week or so. So that is why we have been highlighting some option strategies, particularly the butterfly strategy. Butterfly strategy. Now, the US, first of all, the US Fed decision, what it means for the coming week and months. The global markets will definitely be under pressure, and also we saw the rupee going up to 80.80 today. So this is a big development, and this probably can hurt the flows, because you have a depreciating currency, so the flows can get affected. Probably this will have some impact on the Indian market, because of course FIs today are not a major investor. It is the domestic institutions which are doing it, and probably that is one of the reasons why we have started to get away from tracking the US markets. So we are moving in a different orbit, but we should know that there are certain pockets of markets which are tagged with the US market. For example, IT, then commodities like steel. So these are moving generally, very close with the overseas developments, because there's a lot of ramification, because we are not Indian-oriented industry, IT industry. Similarly, the steel, it's a global factor. So those areas where there is a big amount of impact of global developments on the Indian company's performance, those stocks are not doing well. So that is why we have said that probably you have to be very careful about IT and commodities. So these are two areas which we need to be very careful. But overall, since the credit growth is good, the economy is doing well, and because the commodity prices are falling, the auto sector and the banking sector, I think these are standing out as good investment. And of course, there are FMCG companies like HUL which are also doing well. So we need to work out our strategy for stocks depending on what we see. See, last time we said about the commodity stock, particularly the Tata Steel. We gave one strategy which is towards the bearish side, And in the case of Nifty, we highlighted probably either you can go for a bull call butterfly spread or a bear put butterfly spread. So we highlighted what is the rate for both of them, and no, the decision was to be made based on each one's view about the market. Last week we said the Nifty, since it had cracked below 17,710, said that any rise probably will meet resistance between 17,850 to 17,950, if you may recall our webinar last week. So this time it went up to 17,920. So we said up to 915 also, because we drew the Fibonacci levels 61.8% to 78.5% of this move. We said that probably it could go right up to 17,840 to 17,950. So that is where it may end. And it does happen. No, it went up and then it has started to slip below that. So right now the overall structure of the Nifty is bearish to the extent that we are seeing on the daily chart a lower bottom compared to this bottom. We have got a lower bottom compared to this high. We have a lower top. So we are getting lower tops and lower bottoms, and that is an indication of a bearish trend. And we also highlighted with the help of moving averages. So let's look at the moving averages. And then after that we will go to the strategies that we discussed, and also look at the strategy that is that we can do it now. So so on a close basis, the 10-day moving average was not broken, and look at the 20-day moving average. So it is now whipsawing on the 20-day moving average. It's going up and going below the 20-day moving average. Now we look at the 5-day and 50. So 5-day is not giving any good picture. So we'll go to look at the 50 now. So 50-day moving average now is coming closer to 17,310. So we could probably look towards getting support closer to 17,310. So 17,310 is a next important support level in case if this trend line is broken. So we can expect some support right up to 17,300, and we have to keep that in mind while doing our strategy for coming week. At the same time, this level 17,920. So the overall idea that we can get is 17,920 to 17,320. So the movement could be between, this is an expected range, and the markets can become bullish if it is going to break this. If it is going to break the 17,920 levels, it can again become bullish. Now before that, it will have resistance much below the 17,920 based on this trend line now. You can see tomorrow if it is going to go up, then it may have a resistance at 17,760. So the first resistance that we could see will be 17,760. Then important resistance can come closer to 17,920. So these are the two important areas which have to be watched. And today, having the market having closed at 17,629, So it is closed at 17,629, which makes 17,760 as a very important resistance in case if it goes up, and then probably it can even slip from there. So depending on the developments that we may see tonight in US markets, we will have some reaction coming tomorrow. But we cannot get carried away by the overseas developments these days, because our market is now different from what's happening with the globally. But we are also not sure whether it can tag along with the global market at some stage or other. Okay, so right now it has decoupled itself, and so we need to analyze the Indian market on a standalone basis without comparing ourselves presently with the US market. So that's the important factor time being, because till recently, if something happens in US markets or something happens in European markets, we tended to follow that. Now that is not happening, so we need to view this market differently, except certain sectors like IT sector and commodity sector for the time being. Now, if we look at the resistance support levels, so we said that 17,780, 17,760 right now. So that's a very important level of resistance. And we have always maintained that if the market is going to look a little bearish, suppose if you take a call that it is bearish, normally it doesn't close. It doesn't close above the low. Now today, if you look at it, today also it is closed below yesterday's low, right? So yesterday's low was 17,663, and today it closes 17,629. So this gives a clue to you that any rally which you get above, suppose if it starts to fall, so this is the fall here. If tomorrow the market has to remain bearish, mostly we will have a close which is below this close of 17,629, and also a low, and also a close which can be even below 17,532. Because if you see, most of the bearishness normally comes if the previous day close is below the low of the prior day. Now you see, this is the today's close is below the previous day low. If that happens, there is a tendency that tomorrow also probably we can have a close which is below even 17,532. So that is that's a possibility. So we have to use this particular idea in our mind. Suppose if you see the close going above the previous day low, then on the close, then at the time of close, we can look towards even buying. We can look towards buying. This happened this day, right? So this happened this day, that we see the close. Here it is above the previous day low, 17,622, and this is 17,530. So at the close 17,622, we can look towards being on the buy side, and next day we got a good up movement. And again, if you see this day's close is below the previous day low, that means we could maintain our bearishness. So we can look at this from this and then take our call of the next day what is likely to happen, because mostly the markets tend to follow the futures market also in US, because if we are going to have a good close, that means the overseas market is also reviving, and probably that particular day it could be good. So next day morning, depending on what we see, we can make an exit and then look towards so instead of doing intraday, you can just have a position overnight, okay, and then close it the next day morning also on spike, okay. So either side. Now, of course, that needs a little bit of probably the strength to overcome a complete reversal in the market. So we need to look towards some sort of an option strategy instead of a outright future strategy in these cases, if you are going to have an overnight position, because these days the markets are like that. Now, having said that, we will look at the Bank Nifty also, and then probably and also now review the strategy. So let us review the strategy for Nifty, which we suggested. So last week, that is last Thursday, so today is the Thursday is 22nd. So 15th, if you look 15 closes 17,877. So we said that normally this market doesn't closes within 2 times the option price. Option price at time is around 175 or 180. So said 350 to 400 rupees should be from that particular close. Okay, from that week's close should be the next week's close. So if you look at 17,877 and right now we have got at 17,629. 17,629. So it is around the 250 points, 250 points from the previous week close. So we had suggested two structures that time, since it was 17,825, 827 levels. So suggested that probably we can look at the 17,900. Bull call means 18,100 and 18,300. This is one structure, and then we suggested that this could be rolled down in case if the market dips. The market dips down. Now from 17,827 that day, we saw the market coming down to 17,622. So when it came down to 17,622, what we could have done is that we could have gone for a taken this loss of this call loss, 17,700, 17,900, 18,100. Okay. So some loss and then doing this trade. Okay. And for a considerable period of time, this was into a good profit till yesterday. It was at a good profit. Now, if you have left it open, then probably today, since it closed at 17,629, we would have lost something. The premium which should have paid is around 30 rupees. That's what we said. We could have lost a premium which is around a premium loss of around 30 rupees. That is okay, because the week before we made good money around 120 or 130 rupees. So even then, if we lose 30 rupees, still we have made some decent money there. The opposite side, that we looked at the bear side, it was 17,800, 17,600 and 17,400, which we suggested, closer to some 25 rupees or so. Closer to 25 rupees. Now it closed today at 17,629. That means we had no loss from this trade at all. So 17,800 to 17,629, 171 rupees. Straight away 171 rupees. 171 minus 25. So 146 rupees profit. So even if you have done a straddle butterfly spread, 146 minus probably 30 rupees, we would have still made 116 rupees. And the week before also, we would have made some money. So it looks as if even a straddle type can make butterfly spread, can make some money. If you place the spread properly. So that is where it is very important. So how do we place the spread? Now butterfly spread itself, it's a very conservative strategy, meant for those who want to be passive, looking at time decay within a shorter time frame, and trying to maximize the profit around the midpoint of the range. So the estimation of this where it will close can depend on the technicals, and also can depend on based on the option premium. Now this 18,100, it is now not crossed 18,100 significantly, so that means this is a very important place, right? So 18,100. Similarly, now we showed 17,325 or 350 levels, so we'll keep 17,300. So we expect that 18,100 and 17,300 to be some very, very important resistance and support level. But even before that, since the market closed at 17,629, so 17,900 also is a very important resistance. Now, for the last couple of weeks, if you see, the close is around, every week, the close is around 17,600 levels. For many weeks, it has closed now like that. I don't know whether it is being, to some extent, managed during the settlement period. See here, if you look at it, this is 17,758, 17,558, 17,539. Here it was 558. This is 539. This is 877. then this is Friday close. So we look at the Thursday close. It is better to look at the Thursday close for doing the settlement period. So this is the 15th. It was 877. Then 8th, 798. Okay. Then first, 542. So you look at it, it is just between 500 to 700 on the upside. 17,500 to 17,700 800. So the close is being managed around the 17,600 plus or minus 100, 200 points. So we are getting a feeling that probably it is the settlement prices are coming anywhere between say 500 to 900. Between 500 to 900 is what we are getting. Okay. So if you put the spread in such a manner that it is not crossing 900. Okay, it is the close is not crossing 900. At the same time, it is not crossing below 500. That is why the straddle butterfly placed in this particular range can be a winner. So if you had placed even 17,000, this time 17,700, 17,500 and 300 also, we would have made money. Okay, some money we would have made. Even a straddle spread, we would not have lost anything at least, because they got 71 rupees, so we would not have lost. Similarly, last week also, we would have made some money, because we would have placed between 700 to 900, so we made a full money there. And even in the straddle, you would have made a good amount of money there. So it is something where between the 500 to 900, we can still try. Between 17,700, 500, 300, 17,700, 900 and 18,100. So I would prefer a strategy like this, which we can review it again. So a bull butterfly spread. $17,700, 900 and 18,100. This is a bull butterfly spread. On the bearish side, we can put 17,700, 17,500 and 17,300. This is another strategy that can be considered, because right now most the markets are looking a little weak, but it is completely possible that even if there is a fall towards 17,300, it can revive. It can revive back and try to come back above the 500 or 600 levels. So either one of, because going above 18,100 in the present circumstances, when things are not favorable globally, very difficult to visualize that it can be above the 18,100. So we could probably look anything between 17,300 to 18. The market now probably anywhere placed here can give us a profit between 17,300 to 18,100. Anything between 17,300 to 17,800, depending on the option premium that we are going to pay. So let us look at the option premium in this case for the bull and of this nature. So we'll look at the options price. $17,700 call is 150, 150 and 17,900 is 70. So you get 10 rupees and 18,100 is around 26. So probably we may have to pay something like 36 rupees in this case. 17,700, 17,900 and 18,100. We may have to pay 36 rupees on the bull call. On the bull call, we have to pay something like 36 rupees for this. Yeah. And for the bear spread, 17,700 is around 200 rupees. Okay. 17,500 is 112. So we get 224, 4 paise. And 17,000 1 minute. So 17,700 is 200. 17,500 is 113, 226 rupees. So we get 26 rupees here. And here is 59. So 33 rupees. So here also we pay something like a 33 rupees. Now, if we subscribe to the view that it is going to be a bearish trend, it is going to be a bearish trend, then in that case, no, we don't need to do this. Okay, so it all depends on the view that we are going to take. We just do a bearish spread and just pay 33 rupees and see between 17,700, 500 and 300 what is the outcome, because right now we are getting a spread option premium which is an average of 175 rupees for 17,700. Okay, so expectation is that it will close, definitely most of the time it can close above 17,350. 17,350 is what is expected. Now if you look at the 17,600 put also, it is 150 rupees. So 300, so 17,000, probably 17,300 to 350 levels is what is expected on the downside. So I think we are reasonably placed our bear spread in this particular area. So the week before also it closed 17,825. Reasonable to expect for that particular week option premium into double into next week can go up to 17,300 or 350 or 400. So those who want to do a bearish spread can think about this. And if you don't want to waste that premium, then if it crosses 17,900 levels, if Nifty sustains above 17,900, then in that case you can remove the structure. If Nifty is going to sustain itself slightly above 17,900, we can remove the structure. Now those who are looking, of course I'm not suggesting this, but if you are looking at the market not unlikely to go above 18,000, 18,100, because it has closed at 17,625 right now. So even if a bull spread 17,700 is around, if you look at it, is 150 rupees. So into 2, if you take 300, 18,000. So market is not expecting much above 18,000, 18,100 levels and all. So those who are looking at 17,700, 900, 18,100, on the bull side you can go for a ratio spread. What I'm saying is, of course, bear side I wouldn't suggest because the market is like that. So 17,700, 17,900 can do a 1:2. 1:2, and we get 150 and 70, so 140. So you pay 10 rupees. Just pay 10 rupees. So if the market is going to slide, I think our loss is going to be only 10 rupees. Only about 18,100 we are likely to make a loss. Only about 18,100, and if it starts to move above 17,900, 910, then probably we can look towards plugging that 18,100 by buying 18,100 call. At that time we can buy, because if you remove that you will make a loss in the structure, but you buy 18,100 call at that time, whatever it is. So if it starts to get between 17,700 to 17,900, we still may have a chance of making money, but that depends on the premium of 18,100 at that point of time, or otherwise we can remove this. Okay, or otherwise we can remove this at some stage. But suppose you are very, very conservative and you don't want to take any risk, probably instead of 18,100 thing in the butterfly, you can do a modified butterfly with the 18,200 call you can buy. So probably you will have a very less amount to pay as a premium. You will have less amount to pay as a premium. Okay. So 18,200 is around 15 rupees. So probably the maximum that you would have paid is something like 25 rupees. Maximum that you would have paid is something like 25 rupees is what probably we would have paid here. So you can take 1:2 year, okay, or probably you can look towards doing this 17,700, 17,900, 18,200 for 25 rupees. But paying 25 rupees also is not, it's not that worthwhile. Instead of that, you can do 18,100 itself and pay 35 rupees thing. So 17,700, 17,900, a ratio spread probably could be a very good choice for you to make. Okay. Now, similarly, if you look at the bear spread, the 1:2 I wouldn't suggest, because market is falling. At that point of time, we may be at a big risk. So a bull call spread is okay, but bear put spread, kindly don't do that. Okay, ratio spread, don't do that. Now we look at a three-legged structure. Three-legged structure. Let us say we are not expecting about 18,100. 18,100. So if you sell this option, we get around 26 rupees. 26 rupees. Now, if we do a 17,600 thing, which is around sorry, it's gone. So 195 at 200 rupees, and then 17,600 is around 152 rupees. Right? 17,600 is 152. 17,500 is 113, 114. So we pay something like a 38 rupees. 38 rupees. And 18,100, if you sell, we are going to pay do 26 rupees. So that is what we call as a three-legged structure. That is, you have, in this case, you are buying a 17,600 put, buy 17,500 put you are selling. Now you have a premium which is around 38 rupees, let us say. Now you want to negate this, and you want to place something which is a level which is technically a level which is not likely to be reached. So you do an 18,100 call sell, which is around 26 rupees. So you pay 12 rupees, and if it goes down below 17,500 during this particular week, or ends below 17,500 this week, you will make 100 rupees minus 12 rupees premium which you have paid is 88 rupees. 88 rupees. So our risk starts above 18,100. Our risk starts above 18,100. So those who are looking at structures where probably you pay less premium, for that premium you're going to get good money, and you're going to place your sell at a good technical levels, and in that case you can consider. But only thing is, here there will be a good amount of margin that you have to pay. Good amount of margin that you have to pay. So that is a very important and probably a drag factor compared to doing a butterfly or a simple bear put spread or a bull call spread. So those who are looking at probably a strategy where you are looking at a bearish situation, my suggestion is that you buy a 17,600, 17,500 bear spread, and just keep rolling over this position. Just keep rolling over this position up to 17,900. Now let us say you're done 17,600. If it goes to 17,700, 800, 900, you roll over this position by paying 10 rupees, 10 rupees, 30 rupees or so you will pay. Above that, probably you're anyway going to make a loss. Okay. And because it is unlikely return below 17,600 to 500 at this point of time. So you take that loss of 20, 30 rupees which you have paid and leave it. Otherwise, what could happen is, let us say you have rolled it over, and probably you're paid for rollover charges 30, 35 rupees you have paid. But if it starts to come down, okay, and let us say it goes up to 17,900. It goes up to 17,900. Then in that case it starts to fall like last week. So this last week also, if you see, at some point of time the market was 17,900. Okay, then it came down to 17,650 or so. Then it again went up to 17,910, and then it started to fall. So by doing that, you are by doing that rollover, you are trying to place yourself very close to the market. So in case if it is going to come down from some important peak, you are still going to make money. So because normally we don't say more than 400, 500 points, and then after that there's a chance that it can still slide by at least 100 points before the close, doing which you can recover your money. So the suggestion is that you can look at 17,600 to 17,500, and since 17,900 is a very important top, you can, for the next 200, 300 points, you can just roll this over, okay, and try your luck till the end of the period. Now the same thing if you have done in this particular week also. See, the call spread, let us say this particular day, which is on 19th, this is on Monday. You would have done between 17,622. Let us say you done 17,700 to 800. Now when it went up, okay, there is no problem. You would have had a profit. So now today it came down to 530, right? 530. So probably you would have rolled down from 622, because there's an 100 point lower you got. So you might have rolled it over this particular position, that 600 position, 600 to since this close was 622. Let us say you're done 17,600 to 700 levels. Probably you would have rolled it from 500 to 600 today also. Okay. In that case, you would have cut this position and made a loss, and then taken this position. So if it had revived much higher, you would have gained more. But in this case also, you would not have lost much, because whatever that you got as a paid as a premium between 17,600 to 17,700, partial premium would have been recovered between 17,500 to 600, because this is closed at 629, right? So what you would have done is that probably you would have gone long at 500 to 600 today, and you would have paid that extra premium for that. Okay, by rolling down from 600 to 700, you would have cut it off, and then a 500 to 600 levels. By doing that, you would have paid a little bit of premium higher, but the close was above 17,600, which means you would have got the full 100 rupees. So still you would have made a profit out of this situation today. Similarly, the same thing can be said about the position on the put spread also. So right now, if you take a view that this high is a very important high, 17,900 high is a very important high, and in that case, whatever put spread that you want to do, okay, then you can do the put spread and just keep rolling it over for another under 200 points, okay, and then if it starts to fall, then bring it back to the same position, and then it slides down further, you will make more money. Okay, so based on this, you can look at how to do a three-legged structure, or a call put spread, or a call bear spread, and keep rolling over the position depending on the movement. Now since the high to low normally in Nifty is around 400 450 points in a week I'm saying the range. So probably for every 100 rupees point you keep rolling over, maybe you'll do some three rollovers, and after that probably there will be a reaction on the opposite side. Normally it happens. Okay, only in extraordinary cases it may not happen. So what we are suggesting is, if it goes above this, then probably you can cut off your position. You can cut off your position if you want. Okay, so this is the mechanism for doing this three-leg structure, rollover of call or put spread, and butterfly, which you indicated a bear butterfly spread to do. Then let's look at the Bank Nifty position right now. So Bank Nifty also on a day basis, it is having a lower top. So this is a top, and this is on the top. So we expected this to go a little above the 42,000 in case if it sustains. So we suggested a 41,500, 42,500 for 67 rupees. At some stage it was profitable, but today the close is 40,630. So we would have lost that 67 rupees because it took a 41,500, 42,000 and 42,500. So for a big profit of 500 rupees, or somewhere around 300, 400 rupees profit some stage to come, we decided to take a 67 rupees hit, and maybe this time it did not bear fruit. Okay, So it came down to 40,630 levels. So right now we expect strong support to come at this top. So this probably could be a very important place. That is 40,070. 40,070 could be a very important support. So close to 40,070, you can look towards taking some long positions in Bank Nifty. Technically speaking, you can do that. Now here also, if you want to do a butterfly spread, see last week we were on today is 22nd, right? So 15th it was 41,209, 41,209, and this time it has closed 40,630. That is around 600 rupees. So it is within the two times of the option price. Only thing is, this time it just it was a little on the bearish side. We took it on the bullish side, so it didn't work. So it is on the bearish side. But Bank Nifty generally, since it is performing well, we took a bull call butterfly spread. But considering the global development, it didn't do that well. So right now we are this is a little on the bearish side. So we may at this point of time to take a bull spread may not be that advantageous. So what we really need to do is that we need to wait for some uptick before we do the bear spread. So now we look at this. Okay, so let us say it revives itself to some higher level, 41,180 or so. So this is the high of today. So let us say it goes a little higher. Then in that case we can do a normal bear spread, or we can do a butterfly spread also. So right now those who want to do a butterfly spread, 40,630. So let us look at the option premium for next week. So 40,600. This is around 550 rupees. So 400 to 500 rupees. That means it is expected to close within 1,000 points. That is what the indication is. So either we do something like 40,000 since it is already close to the 40,600 mark. Since it is expected to close within that 1,000 points range, okay, we can do either a 40,600, 40,500, 40,000 and 39,500, because it could take support. Basically, we expect some support to come back into Bank Nifty. So, considering that what is the previous week's close, that is the so 15th. So 15th it closed at 41,209. 41,209. If that be the case, then probably 41,209 at that time the option premium for the second week would have been something like 700 rupees or so, 41,000 at 41,200. So 1,500 points from there if you take. So the expected close could be for the second week from there. If it is on the bearish side also, probably around 40,000. Let us say 40,000 or 39,800 also. So we could probably look at that basis also and do a 40,500, 40,000 and 39,500, and let us say what we get. Option premium. So 40,500 is 384. 40,000 is 220. 220. So 440 we are getting. And this is also 449, so no loss, no profit. No premium. 39,500, 120. So 40,500, 40,000, 39,500. This premium is coming closer to 120 rupees. It's 120 rupees. So if you don't want to pay that much of a premium, we have to look at something like 40,000, 39,500 and 39,000. But much below 40,000 it may not close. So You have to look at 40,500, 40,000 and 39,500 by paying this 120 rupees premium. In case if the market is too slight, then we can get a decent amount of profit here. Now, if you do only 1:2 year, then you don't need to pay the premium, and your loss will start only below 39,500. Your loss will start only below 39,500. Generally speaking, we should not do such a thing as far as the put spread is concerned, because there could be a black swan event. There could be only one situation. That time we will not be even able to close the 39,500. So better we have to be very, very careful about that. So somewhere or other we need to always put in our stop loss. So if you don't want, then probably you can even look at 39,000, but don't do without anything. So here probably 39,000 comes around 63 rupees. So we can do this. That is 40,500, 40,000, 39,500. Assuming that it is not like to go below that, then probably you can do 39,000 for 63 rupees. For 63 rupees and see what the result is. So you are taking some risk, but probably a worthwhile risk than which is a high probability of a profit. So you can think about 40,500. This is a modified butterfly spread they call. 40,500, 40,000, 39,000. The risk is 500 rupees. The risk is 500 rupees here. So if you want to manage at some stage there, you can always do that. Otherwise, you pay this 110 rupees, sorry, 120 rupees for 40,500, 40,000 and 39,500. Okay. Otherwise, we have to do 40,000, 39,500, 39,000, just pay 63 rupees. Okay. But very unlikely to see that ending much below 40,000 or much below 39,500. So it's a question of sometimes it can happen. So let's say between 40, 39,500 and 4,500, 40,000 and 39,500. For some correction to happen, we are keeping this. Okay. So if we look at the this is a 50-day moving average. So we look at the 20-day moving average in this case. So 20-day moving average coming closer to this place. So this is 40,170. So there will be definitely some revival coming from that place. And let's draw the trend line also. So approximately most of the points are chugging along this line. So we should see some support in coming days closer to 40,000. Closer to 40,000. So expecting a fall much below 40,000 is a very unlikely scenario. So what you should do is if you do want to do 40,000, 39,500 and 39,000 for 123. Now if it comes to 40,000, that time see what is the gap between 40,500 and 41,000, 41,500. Okay. So if it is going to be only 50, 60 rupees or so, you do the bull spread also, bull butterfly spread at that time also. Mostly you will get up at a very good profit. So our view is that we should do a bear spread right now. At 40,000, you do a bull spread at that point of time between 4,500 and 41,000. Okay. So we have now explained what is the three-leg structure, what is the butterfly structure, and also we have given illustrations in Nifty and Bank Nifty. So if you have doubts, please ask. Thank you. Option buyer, how to select entry and exit. So if you are an option buyer, if you are going to be a plain call and plain put buyer, okay, most of the time if you do consistently you will not make money, because if you continuously buy call and if you continuously buy put, both you will not make money over a period of time. But you have to see the trend and decide about what should be done. Now right now if it is bearish, okay, so you can do a put spread. You can do a put spread. Okay. but you should not waste too much of an option premium. So the strike that you should choose is that right now it's 17,600. So what is 17,800 or 17? Because if you go deep, slightly deep in the money, you will not have much of a loss as far as the time value is concerned. As far as the time value is concerned, it's maximum at the money. So either you go for a completely out of the money and look towards some big profits, or you go for slightly in the money like a futures and put in a stop loss because you're paying a lot of premium. In this particular case, since the market is bearish at present, I would do something like a 17,800 or 17,900 and definitely put in a stop loss. And that particular stop loss could be either a particular day's high, which is today's high. If it is 17,700, let us say today's high in Nifty, if it is 17,722, so the first stop loss will come for me at 17,722. Now otherwise I will put the stop loss above 17,900, okay, approximately above 17,900. So on any revival, to do a put, let us say 17,700 or so, the market goes up 17,730 or 40 up to that level, and in that case you do a put and then remove that put in case if it goes above 17,920, 17,920. So that is how you should choose, where an important pivot points of support and resistance should be the strike price. Now 17,920 right now is the high, okay. So your strike for the put, not to waste too much of time value, should be 17,900 or so, and that itself, that same level should become the stop loss. Thank you very much for participation. See you next week. Thank you.